Well, thank you, Herbert. And I first want to thank IMS and the World Manufacturing Forum for enabling SCRA to participate. We're very excited about being here and having the opportunity to share with you our experiences. I'm going to talk a little bit about our corporation as a whole, but I'm going to focus on the programs that we have for startup investments. It's important to know, we've been talking during the forum today about the nexus between public and private partnerships, and it's important for you, I think, to place us correctly in our positioning, to know that we are a non-stock, tax-exempt, applied R&D company, which also operates under a public charter from the state of South Carolina to foster what used to be called technology-based industries and is now called the knowledge economy. While we have been chartered by the state of South Carolina, it's also important to know that we are an independent enterprise corporation with our own board and our own governance. We are not part of the state government, and we do not receive, nor frankly do we want, annual taxpayer appropriations from the state. We basically generate our own revenues, and we're self-supporting by competing for, winning, and delivering applied R&D contracts. And basically, our primary purpose is to take discoveries and prototypes out of labs and off of benches and get them operational, and we do that under contract to the U.S. federal government, a variety of agencies, which comprise about 70% of our revenue. And we also perform contract R&D through a variety of consortia that we develop and operate. And about 30% of our revenue comes from corporations for whom we also perform contract R&D. What you see on this slide is the track record we've had over the years since I was brought in by the board in 2005. And our fiscal year, which ended yesterday, fiscal 14, we're actually going to beat that number that's up there. So one of our slogans is under promise and over deliver. With respect to our public charter, in the 31 years of operation that SCRA has toiled, through our own operations, our network of in-state suppliers, our SC launch portfolio investment clients, which I'll talk about a little more in detail, and the roughly 42 corporations that are technology-based that reside in our research parks, we've helped contribute over $16.6 billion to the economy of the state of South Carolina, and we've helped create a little more than 15,000 technology-related jobs with per capita wages of between $55,000 and $77,000. So we've been very strong in our business operations recently, and we continue to be very strong in fulfilling our public mission. Just to give you a little profile of how we do this, we have three business sectors. The core pillar, which constitutes over 90% of our operation by revenue, is our applied R&D business. And this is the basic engine that drives the margins that we reinvest in our startup clients. We also have an R&D facilities business, which accounts for about 5% of the operation by revenue. And to Herbert's earlier remarks, this is where we have the ability to house and equip not only our own operations, but our co-located clients in the investment business. And one of the ways that we help our clients is basically housing and equipping them on a payback kind of basis. And then the last 5% of our operation by revenue is our technology ventures business, which is a seed and early stage investment business. And since 2006, when we made our first placements, we've helped 4 more land in and around South Carolina, North Carolina, and Georgia, about 290 startup businesses. The top 70 of those, we've invested about 19 million of our own funds in. That 19 million of investment has now attracted 310 million of private add-on investments. We have had 9 exits since 2006. The first 8 had an average IRR of 28 8.5%. And the most recent exit, which we had this past May, quite frankly, we haven't even calculated the IRR on that one, but we did get a 6.7x cash in, cash out return. Let me focus from our tech ventures experience on some best practices that we would recommend to the group. The first is to cultivate a stable of stable co-investors, right? Sorry about the double entendre there, but what you want to be able to do is to de-risk deals, but also share that risk by having competent co-investors with you. One way to help develop that stable is to avoid onerous terms. I'm a veteran of the 90s venture capital period where the biggest battles were between the investment partners and instead of the marketplace, so we try to avoid that. We like to make it easy for add-on investors to come in by avoiding onerous terms. We also have the ability to leverage tax credit structures in South Carolina. With the help of the state legislature, we created something called the Industry Partners Fund. We, as an IRS 501c3 under U.S. law, can solicit private donations. And so we are able to raise capital through private donations. And as a 501c3, our donors can take not only a U.S. federal credit of up to 35%, but they also can receive a dollar-for-dollar state tax credit for donating to our fund. So we have a mechanism that's capped at $6 million annually that we can run. And so that's been kind of our seed capital for our seed stage investments. And to that, we've added our own bottom line and also our co-investors. Now, the fund doesn't operate as a fund. Our co-investors invest with us directly in the company. So it's not, we aren't managing any kind of funds. But one of the things that it has proven to be is a very strong program. And while we're not experts on taxes, we just certify the donations to our state Department of Taxation. We do know that some of our donors not only take the state deduction, but take the federal deduction. So very often they can get $1.35 back for every dollar that they put into our program. So it's a great mechanism. The other thing I would do, and the reason I shared our results is I think a lot of times programs are afraid to share their actual results. And the only way you're going to get competent co-investors is to let them know what your track record is. Now, I gave you the good stuff. The struggle that you always have in that 290 company client base is that we have about 35 or 40 companies that have either failed are just pedaling hard and not going anywhere. So there's some flotsam and jetsam down in the bottom quartile of our client base like anybody else. But what we don't do is we don't invest in a market with a spread of companies. We really take each of the companies one at a time, and I would suggest if you're investing, you do it that way as well. As far as placing capital is concerned, the key is to find local, world-class technologies that are in fast-moving market streams. Any company who's succeeding has one or more strong waves behind them pushing them forward. And if you can execute within the requirements of that wave, the company is going to succeed more or less. And we try to find and coach those companies if they got a great technology, and they're not in a fast-moving market. One of the things we do is help them get into those markets. And one of the ways we do that is to have them qualify as subcontractors to our large-scale federal and corporate R&D contracts. The other advice would be to invest in what you know. We invest in vertical markets that we work in the R&D space in. So we're used to looking at immature technologies in our core business and getting them to fruition as part of our contract fulfillment. And we take that know-how and insight and we inject it into our investment business. Obviously look for great people in management. A lot of times the technology isn't the greatest, but the team is outstanding, and they have the mix of skills that you need today to get ahead in a startup. The other thing is, we have a small staff of 7 people who help us find, assess, do due diligence. It's the it's the old find 'em, grind 'em, and mind 'em equation. Your people must have startup experience too. With all respect, if the brother-in-law of the director general is appointed to the staff, just for political reasons, it's not going to work because it just won't work. The other thing is, and this is kind of a contradictory coaching on two sides of the equation, but in advanced manufacturing technologies, they take a lot more capital and a lot more time than a software company. So what you have to do is you have to be patient, but you also have to make changes and fixes very, very rapidly when you see that you have to change things. Here's some lessons learned. Neither inventors nor investors make great CEOs. If you have somebody on your investment team who says, "Oh, I used to be the CEO of company X, let me go in there and pinch hit because it's not going," don't do that. You're in trouble. Find another CEO that knows that particular market space and can really lead as an operator. I'm going to probably incur the ire of the Clayton Christensen fans that are out there, but I would advise you, particularly in advanced manufacturing and other manufacturing-related technologies, is look for a modification or an incremental technology that's going into a big, fast-moving market. That typically works and cuts down the amount of time. You may not get as big a payoff, but you'll get there and you'll get a return. Also, a modified or incremental technology that is going into a growing or big enough adjacent market. This may be a market you don't know, but it's close to what you've done. That typically works reasonably well. Be very careful of the so-called disruptive replacement technology that's going into an established slow growth or non-adjacent market. The inventor comes forward, he's got a team, and this is going to replace every one of these that's out, every strain gauge that's ever been made. This is going to do better. It won't happen, okay? The other thing is, and this is a corollary, always have an ROI calculation that is delivered by the innovation of technology. One of the kind of the due diligence questions we ask, what is the quantitative improvement in cost, schedule, or function as a result of implementing this technology or this product? And frankly, if the founders can't articulate that or calculate it for you, be very wary of investing. And then finally, the ROI calculations can mitigate this because they can be a sales tool, but don't underestimate how difficult behavioral and cultural change can be for both buyers and providers. Not only you have to sell the company management sometimes, but you got to sell the workers. And if they don't want to use it, it's not going to happen. Okay, just a couple of real-world examples, and these are in the manufacturing space. One's in the biomedical devices. We have a client company, RhythmLink International. They make electronic leads for medical monitoring devices. They had been producing offshore in China, Korea, and Vietnam. However, we've supported them recently and we've talked about reshoring or onshoring or nextshoring to implement robots to replace the hand labor they've been getting in Asia. I will tell you that the capitalization for the robots themselves, their software and the methods, was about $680,000, which is surprised me actually because the price of robots is coming down. I will also, full disclosure, say there was about $800,000 of other one-time costs, including everything from floor setup to buying out the existing contracts. But the results have been a double-digit appreciation over the last 6 months, onshoring to the U.S., and much more predictable and improving margins and quality for the company. Another investment that we have, which is really at the intersection of advanced materials and sustainability, which are two verticals that we're strong in, both in our R&D business and in our investment business, is materials innovation technologies. This company produces new molded parts from recycled carbon fiber. They also can supplement their molded parts revenues with chopped fiber and rolled goods for pre-processed products like pre-preg. The innovation that they have put forth is that they can create molded parts that are half the weight, half the cost of virgin fiber, and they can be upwards to 90% of the strength of virgin fiber, depending on which configuration and materials you're using. But the other part of it that we think is really important is that it's 100% recycled. And we don't think that unless the recycling of carbon fiber questions are solved, that really widespread use of carbon fiber, we talked about automotive and certainly our client Boeing, you know, there's got to be a recycling part of the equation before those materials will get widely used. So the results with materials innovation technologies have been, we've gotten a double-digit appreciation, major contracts with SABIC, and tier suppliers to aerospace and automotive like Zodiac, Axiom, and MFG. And we also have created a co-investment opportunity. Toyota is already a co-investor with us, as well as a North Carolina company, MLLC. And we have a couple of, one European, one Arab co-investor now doing due diligence to add capital to the company. So let me conclude by just giving you a final real-world example visually. This is a company called Zipit Wireless that we've supported through multiple rounds. Excuse me. And what you see here is a picture of the two founders on either side. The guy on your right is the business founder, and the guy on the left is the technical founder, and we like to have those complementary skills. But the other folks are representing our co-investors, which include Windspeed Ventures from Boston, Sunbridge Partners from Ohio, and Meritus Ventures from Tennessee. The capitalization there, if you can read it, was $4 million. And the company now is in revenue and cash flow positive position, going to make their first quarterly P&L profit this quarter. And they have really great clients like Verizon Wireless, FarmRight, and a variety of medical paging companies who are using Zipit Wireless as backbone to basically upgrade software on their remote devices, which is the unique skill that this company has. So in conclusion, I hope I've been helpful, sort of show you how we're doing what we're doing. And if we can interest you in perhaps taking a look at our pipeline and some of the other methodologies we have to support this kind of investment business, we'd be delighted to talk to you. Thank you very much.
Yes, Bill, thank you. Thank you very much. That was very, very interesting. And for me, it was straightforward. It was clear. It was just the principles you gave and the live examples you gave. I must admit what I liked most was the advice, be patient and learn quickly from your mistakes. That could also be a good recipe for a marriage. So it is what you what is perhaps not only in the company world, where it's needed.